The question is this: will this trade fight turn into an all-out currency war? Let's welcome in Julian Evans-Pritchard, senior economist with Capital Economics, joining us on the CNBC Newsline from Asia. Julian, do you believe that China has now weaponized its currency?
Well, I think it knew what the reaction would be in doing this, in terms of the headlines, in terms of the way it's going to antagonize the Trump administration. And yet it's done it anyway, and it's even explicitly linked the move to the recent escalation in trade tensions and additional U.S. tariffs. So I think it is effectively weaponizing the renminbi, even if it isn't directly intervening to push the currency down, but by explicitly linking it to the trade tensions and timing the move so soon after the tariff threats. I do think we are moving in that direction.
Do you believe that the Chinese government has expressly allowed that offshore currency to go below 7-to-1 to the U.S. dollar? Because in years past, they had kind of defended that level. Julian?
Well, I think it's clearly intentional. I mean, we haven't seen any effort since this morning to push the exchange rate back down below 7. We know they have the ability to do so either directly through deploying their FX reserves or through the state banks. So the fact that we haven't seen any drop back and actually it's just remained at that level just above 7 suggests that this was an intentional step upwards.
Where does it go? How low does the Chinese currency fall?
So I think the goal here is clearly to offset some of the drag from U.S. tariffs. Otherwise, they wouldn't take the risk of breaching 7 in terms of capital flight, in terms of what it means for the trade negotiations. So they're going to want to see it weaken further, in my view, in order to get more of that offset. We now think it could end this year at around 7.3 against the dollar and maybe 7.5 by the end of next year.
Wow. And do you believe, I mean, we look at the other side of this, obviously, there's two sides, right, to the currency story. Number one is it's going to make their imports into the United States and the rest of the world less expensive. To your point, maybe semi-mitigating those tariffs. But it also has the effect of making imports into China, maybe from the U.S. or other locations, more expensive. How does this play out, Julian?
Well, I think it's still positive for China. I mean, China obviously has a current account surplus. It imports less than it exports. So even once you adjust for the higher cost of imports, I think it will be a positive. Because even if exporters don't adjust their US dollar export prices, their export revenues in renminbi will still benefit. So we think a 10% devaluation could actually boost China's GDP by about 0.2%, which would be enough to offset a 10% tariff on 300
But quickly, will this set off a global currency war? Will Vietnam have to devalue? Will the euro have to go down? Then will the United States have to act?
Well, I think at this stage, it's not clear. I mean, at the moment, what we've seen is actually, in the big scheme of things, a fairly small move. And I think that we will, in the coming days and weeks, see PBOC intervention in order to prevent the currency from weakening too quickly. So I don't think we'll see a very major devaluation. I mean, we're predicting a sort of 5-10% decline over the coming quarters. And, you know, I think that wouldn't cause significant problems for other countries. But if things do go beyond that, then it could descend into a broader currency conflict.
Julian Evans-Pritchard, we appreciate your insight. Thank you very much for joining us.